Wall Street's wild years weren't driven by reckless dreamers. They ran on cheap money from a Federal Reserve controlled by private banks. In the 1920s, an average worker earning $750 could borrow $5,000 to gamble on stocks, fueling a bubble few understood. But when the Fed suddenly tightened the screws, disaster hit, and the biggest banks came out stronger than ever. How did those who seemed to lose everything end up pulling the strings? The answer begins with how America's banking system was built for risk few dared imagine. In December 1913, Congress passed the Federal Reserve Act, creating a new central bank for the United States. But this wasn't a purely public institution. The structure put private banks directly at the heart of the system. 12 regional Federal Reserve banks were established, each owned by member commercial banks in their districts. These member banks supplied the capital and chose most of each regional board's directors. The most powerful seat belonged to the New York Fed, whose governor, selected by private directors, wielded enormous influence over national credit policy. The Federal Reserve Board in Washington supervised the system, but real power often rested in New York, where Wall Street's largest banks, like JP Morgan and National City, held sway. The design blurred lines between public oversight and private interest. Regional banks set discount rates and managed credit, shaping the flow of money across the country. This hybrid model meant that decisions about interest rates and lending were rarely insulated from the priorities of the banking sector itself. By the 1920s, this arrangement allowed major financial players to benefit from both stability and flexibility. The Fed could expand or contract credit, but the levers were often pulled by those who stood to gain or lose the most. As the decade wore on, the consequences of this private-public partnership would become impossible to ignore. Throughout the Roaring '20s, a fever gripped the country, stock tickers clattered in every city, and the promise of quick riches reached far beyond Wall Street. Margin buying became the ticket for ordinary Americans to chase the market's dizzying climb. With just 10% down, a factory worker earning $750 a year could borrow the rest and control $5,000 in stocks. Clerks, teachers, even small-town shopkeepers. Millions joined in, convinced that prosperity was just a trade away. Newspapers ran headlines like, "Everyone ought to be rich," fueling the belief that the market could only go higher. Banks and brokers kept the wheels spinning by offering easy credit. Cool loans, repayable on demand, allowed investors to keep borrowing as long as prices rose. The system rewarded risk and punished caution, turning everyday people into speculators overnight. As portfolios ballooned on borrowed money, so did the underlying risk. A single bad day could wipe out years of savings, but few stopped to consider the downside. The rush for profits drowned out warnings, and the gap between real wages and paper fortunes stretched wider with every upward tick. By 1928, speculation was no longer confined to the elite. The entire financial system leaned on a fragile foundation of debt and hope, setting the stage for a reckoning no one believed possible. In early 1928, the Federal Reserve began a series of moves that would tighten the financial noose around the country's credit markets. The New York Fed, with its board dominated by representatives from major banks, took the lead. The discount rate, the cost at which banks could borrow from the Fed, rose from 3.5% in January to 4% by spring. By July, it reached 5%. On August 9, 1929, the rate jumped again to 6%, the highest point since the aftermath of World War I. Each increase meant it became more expensive for banks to borrow, and those costs quickly rippled out. Banks, squeezed by the higher rates, responded by tightening their own lending. Brokers' loans, used by investors to buy stocks on margin, became harder to get and more expensive to maintain. Cool money rates, which determined the cost of borrowing for speculation, spiked in tandem with Fed policy. For the thousands of banks outside New York, the pressure was immediate. Many depended on short-term borrowing to fund daily operations. Now, with the discount window nearly shut, reserves shrank and liquidity dried up. The Federal Reserve's minutes from this period reveal a single-minded focus on reining in speculation. Policymakers saw the runaway stock market as a threat to economic stability, but their tools were blunt. By raising rates sharply, they choked off the easy credit that had fueled the boom. The impact was not limited to Wall Street. From Chicago to rural Kansas, businesses and farms found loans harder to secure. The stage was set for a cascade of consequences as the financial system braced for the shock to come. On the morning of October 24, 1929, the New York Stock Exchange floor erupted in chaos. Crowds pressed against the marble walls, desperate for news as stock prices tumbled. Over 12.8 million shares changed hands that day, a volume never seen before. Ticker tape ran hours behind, unable to keep up with the avalanche of sell orders. Brokers, pale and sweating, shouted into phones as fortunes evaporated minute by minute. Newspapers rushed out extra editions, their bold headlines screaming of panic and collapse. In the midst of the uproar, a small group of bankers gathered at the offices of J.P. Morgan & Co. They pledged millions to halt the slide, buying blue-chip stocks in a public show of confidence. For a moment, the market steadied, but the relief was short-lived. As rumors of insolvency spread, the sell-off resumed with even greater force. By the following Tuesday, October 29, the panic reached its peak. More than 16 million shares were dumped in a single session. The market lost $30 billion in value, an amount equal to the entire annual output of the United States at the time. While the public scrambled to salvage what little remained, insiders who had sold at the market's peak watched from the sidelines. Major players like J.P. Morgan and Rockefeller had quietly liquidated positions in the weeks before the crash. For small investors, there was no such escape. The crash was not just a financial event, it was a collective trauma, leaving crowds stunned and silent as the ticker tape finally stopped. Between 1930 and 1933, nearly 9,000 banks across the United States collapsed under the weight of mounting losses and vanishing deposits. In city after city, closed doors and empty vaults signaled the end for small-town lenders and regional outfits. Their assets, once the backbone of local economies, were auctioned off for a fraction of their original value. Larger institutions like Bank of America and Chase National stepped in, scooping up loans, securities, and deposit accounts at steep discounts. While families lost savings and businesses lost credit, the survivors grew stronger. By 1933, the top 1% of banks controlled almost half, 46%, of all banking resources in the country. The era of local banking gave way to a new concentration of power, setting the stage for the next round of government intervention. In April 1933, Franklin Roosevelt signed Executive Order 6102, making it illegal for Americans to own most forms of gold. Citizens had to turn in their coins, bars, and certificates to the Federal Reserve, receiving $20.67 per ounce, under threat of a $10,000 fine and up to 10 years in prison. The gold flowed into the Treasury vaults, stripping individuals and businesses of their last shield against inflation. Then, in January 1934, the government raised the official price of gold to $35 an ounce. That single move handed the federal government a 69% gain on every ounce collected, while the public held devalued paper dollars. The gold confiscation showed just how quickly control over wealth could change hands with the stroke of a pen. The cycle didn't end with the Great Depression. In 2008, a wave of easy credit and speculative lending set the stage for another collapse. When the housing bubble burst, the Federal Reserve stepped in with extraordinary measures, flooding the system with liquidity. Then, from 2020 to 2022, stimulus programs injected $4.8 trillion into the economy, an unprecedented surge. But as inflation took hold, the pattern repeated. The Fed raised interest rates sharply in 2022 and 2023, putting pressure on regional banks and sparking new failures. Now policymakers are preparing the next tool, a a central bank digital currency with draft proposals and task forces already underway. The levers of control are shifting, but the playbook remains familiar. Today, just 6 banks hold nearly half of America's deposits, far more consolidated than in 1933. As digital currency and new crises loom, who shapes the next collapse and who benefits remains an open question. The real story isn't what happened, but who controls what happens next.